Hi, Drayton. My name
Hi,
is
Nicolette.
Nicolette.
Yes.
Hello. My name is Nicolette. I am based in Kuala Lumpur, Malaysia, and I am the creator for the podcast titled You're Worthless. Read that again. Juxtaposition of your very soul. Thank you very much for saying yes to be interviewed today. I don't know if you've read my profile. So my profile is talking a lot on self-worth, but why I wanted to reach out to you is because I myself I qualified as a chartered accountant back a few years ago, and I still very much hold that very close into my heart as somebody who wants to get the details of what the elite people are doing. When I read your profile, you are definitely the some kind of a subject matter expert in that field. So it is actually an honor to have you here. So thank you very much for saying yes.
Of course, yes. I've heard a couple of your podcast episodes, and I think you're a great host. And I'm looking forward to our conversation.
Oh, thank you so much. Okay, so as part of my ritual, I would like to read a bit of your introduction to our guest today, before we get right into the to business.
Sure, yeah.
So, so hi everyone. We have Drayton D'Silva here, who is the founder and CEO of Tower Hills Capital, a multi-strategy investment firm that he founded in 2023. So the fund's core strategy uses predictive analytics and performance attribution to build optimal portfolios for investors. His fund is backed by senior leaders from Point72, Goldman Sachs, Morgan Stanley, Barclays, and Novus. He coined the term recursive investing, which refers to an investor continuously pricing an asset based on both their own fundamental analysis and their forecast of the consensus. He also managed capital markets and credit risks at Sivo. I hope I pronounced it correctly. He previously worked at Goldman Sachs, DRW, and the Central Bank of India. He is also an alumnus of London Business School. In all his past roles, he learned how to navigate markets, manage risk, and take advantage of opportunities in the market and economy. And yes, we will be discussing some of his learnings today. So welcome, Drayton.
Thank you. Thank you. Yeah.
Yes. Well, again, part of my ritual before we dive straight into business, could you share with us what was it like growing up as Drayton D'Silva?
So it was kind of boring in the sense that, like, in terms of like the formal education, I honestly was pretty bored by it because I felt like I could do more, but then I was in like a public school, so I was always relatively understimulated. So while I would have good grades, I was always looking for more things to learn about. So I was always reading things. And I was like really curious. I would read about all sorts of things. I would read about biology. I would read about finance. I would read about literature, history, biographies. I would read about whatever I could. Um, and I would read some fiction as well because that's sometimes entertaining. And like every kid, you'd read about like Hardy Boys, the Goosebumps, those horror.
Oh yes, I grew up with Goosebumps.
Yeah, I feel like they're not
I
even
got
really
20,
horror.
30 of them.
Yeah, I feel like they're not even that scary. They're more like comedy as well sometimes. And like
Yes.
so thrill. So that was fun. So I would do that. So in terms of education, because I thought the formal what I learned at school was kind of boring and understimulating, that sort of just encouraged me to like explore more, and that was very useful. I like that part. And then in terms of like other upbringing stuff, it was pretty regular, pretty like thankfully it was like really safe and pretty stable. So I'm quite grateful that that stability allowed me to explore my intellectual interests and curiosities. And I was actually I was really into soccer or football, people outside North America call it.
Yeah.
A lot, and I watched a lot of soccer on TV. But then, so I think in high school, I essentially just gave it up, like wholesale. I just stopped it immediately, like cold turkey almost, to focus on academics because, like growing up in Asia, for
Oh
getting to
yes.
stuff, you need to do
Asian
that.
parenting.
Exactly, yeah. So my parents were like quite encouraging of playing sports and stuff, but and they didn't tell me to stop or anything. I just like realized that I need to get serious about the academics. So I was just like, yeah, okay, fine, I'll do practice mock exams for the
Oh my
next 4
God.
years.
Oh, I
So
remember those
that's what I
times.
did.
Just to
Yeah,
score, just to
my
nail
high
the
school.
A's.
Yeah, exactly. So my high school was like quite interesting, where you know how you would actually count how many hours you're studying? I would actually do the opposite. I would count the hours I was not studying. So it was like 7.5 hours for sleep, maybe an hour and a half for
Wow.
hygiene, and maybe another hour and a half for like meals and like other like random stuff. So I would count the hours I was not studying. So I was extremely serious about academics when I needed to be. But the rest of the childhood, I was like, yeah, okay, I'll read and explore lots of stuff. So yeah, that was my childhood.
Wow. And just prior to starting the interview, you said you were living in quite different places all over the world. Share us more about that.
Yeah, I think I think for someone who's not a consultant or someone whose parents were not diplomats, I've lived in many places. So
So that explains it. Your
no, they
parents.
were not. No, I'm saying for someone
Oh,
whose
okay.
parents were not
Right.
diplomats or
Okay.
consultants or something. So I was born in India, grew up in the Middle East, and then did my education in India and the UK, and then lived in Canada, and then moved to the US. And during lockdowns and when remote work was a thing, I actually spent significant amounts of time in Mexico.
Why Mexico? I'm so curious. This is my own question.
One reason is you have very good quality of life at very low cost.
Really? Okay, I've
If
never.
you have a US or Canadian job and you live in Mexico, you can live quite comfortably, like, because labor is relatively cheap, so you get lots of services for much lower cost. So basically just quality of life. And they didn't have as restrictive as lockdowns as in Asia or some parts of the US. So that was nice too. Because I'm in the low risk category, so the lockdowns, like if I didn't lock myself down, it would not really change much for me. So that was sort of like a selfish reason. Like I just wanted like
You want to
explore a
get
bit.
out and
Yeah.
explore a different city.
No, but the thing is, so I live mostly in Mexico City in Mexico, and
Ah.
it's a very vibrant city, very good food, very good restaurants, lots of live entertainment, very welcoming and warm people, and really good weather, like surprisingly good weather. So in Celsius, it was between like 12 and 25 throughout the year. So it's
Oh, that's nice.
and
Malaysia, it's
relatively
we reached 30. I know we reached 40. Okay. Oh my God.
yeah.
God
So
forbid. Yeah.
surprisingly good weather. When you think Mexico, you think, oh, it's like a desert, it's really hot and humid.
Yeah.
In the movies,
Yeah.
that's like, yes, that's in the northern provinces. Mexico City is actually quite south and it's central, so you have really good weather.
Awesome. 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 Well, thank you for sharing that, Drayton. Okay, so let's get down to business. Why do people pay hedge fund managers so much?
Well, there's a few reasons. So one reason is there's actually a joke about hedge funds actually being a compensation scheme masquerading as an asset class.
Exactly.
So,
Exactly.
yeah, that's a joke, but I think the real reason is you get paid to deliver a very specific risk return profile to different portfolios. Let me explain that. So what that means is, yes, you can get, between 5% to 15% by just investing in a Vanguard ETF for 3 basis points, and you can do like a lot. And then you'll see in the news like every few years, oh, the S&P 500 has beat managers by 10%. But that totally misunderstands the point of hedge funds. The point of hedge funds is they give you between 5 to 7% every single year, whether the market's up or down. So these are what's called absolute return hedge funds. So can give the thing is, like hedge funds, they are for institutions. They're not for retail investors. Because the reason for this is if you have a large endowment or a pension fund, let's just take endowments or charities or private foundations that fund other charities, they have what's called the payout rule, which means that they have to spend at least 5% of their corpus or their endowment every single year. So if you have 100 million, you have to spend at least 5% every single year. So which means that the endowment, to maintain its long-term viability or the long-term principal value, if you're spending 5%, you have to be making 5% plus inflation each year. So which means that an endowment needs to have a return of 7 to 9% every single year, whatever happens. So so basically it's a question of having liquidity and long-term viability at the same time. So if you have these spending needs, you have to the endowment has to earn sort of that 5% plus inflation every single year. So that is approximately 7 to 9% every single year. And if you look at all these large endowments, like the Yale endowment, the Harvard endowment, they are between 50 to, they're like 50, like 40 to 50 billion. Like these are the two largest ones. And they spend 2.2 to 2.5 billion each single year. And that accounts for approximately 35 to 40% of the expenses of that university. So they are the largest single contributor to the funding of a university. Another large part of the funding comes from alumni donations. And the thing is, alumni donations are very highly correlated with the stock market, because when the stock market is up, there's something called the wealth effect, where people feel rich and they'll spend cars and make more charitable donations. So what hedge funds give you is a low correlation with other assets. So, and what that means is, if the market is up 10% or the market is down 10%, they will still give you that 5 or 8% every single year, because that is uncorrelated, and which means that they can continue funding their, they can continue funding their mission every single year. And then the way this applies to pension funds is that
yes, that's I'm
have,
more familiar with pension funds.
exactly. So like, if you pay a Vanguard or pay Fidelity, what they are giving you is the market return plus or minus 3%. And then the market return could be 10% one year, it could be down 20% one year. And that is unacceptable to endowments and portfolios. And private charity portfolios. So they cannot have that. So they need to get that 7-9% every single year. And now the way they do it is what's called the endowment model. And that was pioneered by David Swenson and Dean Takahashi at Yale. So what that is they put like 50% of private equity, venture capital, real estate, basically private illiquid assets, and then maybe 30% in public equities. And then the rest is like cash and fixed income, specifically government bond securities. So basically long term, they'll earn high returns, 20-25% each year. But in the short term, they make sure that they can still meet their spending needs for Yale or for Harvard or whichever endowment that they have. Because 35-40% of the operating budget is the biggest chunk. So if you can give someone 10% each year with the plus or minus 2%, that is way more valuable than if you can give someone 25% with plus or minus 14% each year. So, or whatever, 15% each year with plus or minus 10% error rate. So they are getting paid for reducing uncertainty. So this is like on the investing side. But if you want to talk about the business model, so it's very scalable. It's been described as a 2 and 20 fee structure, which means that, okay, if I'm an endowment and I give you $1 billion to invest, you get 2% of that $1 billion each single year, because you're managing that, and you get 20% of the profits. So whether you're managing 100 million or you're managing $100 billion, the fee is effectively the same thing. I mean, yes, you have a larger allocation, you get a bit of it, but basically you don't need to change much, because so it scales really well. And the second way they get like paid a lot is the fees, but then also they'll invest their entire net worth in their own fund. So if you're getting the 2 and 20, but then also if I have 100 million net worth, I have 10% returns, they actually, when the media reports it, they actually count their capital gains as also their salary. I mean, it's not their salary, it's the capital gains of the net worth that's invested in their portfolio. So there are like some misconception how it's reported as well.
Yeah.
Yeah, so these are like the two main reasons. And then maybe the other reasons why you see, hedge fund managers get paid so much is because they're only looking at the survivors, the most successful ones. Like the survival rate for hedge funds is actually quite low. So it's not as low as startup funds, but sorry, I meant as startups, but it's still pretty low. It's like mostly like something like only 30% of hedge funds survive after 5 years. Like, I don't know the exact stats, I can't remember them. But like saying, if you found a tech company, you'll become a billionaire. No, that's not true. You're sort of only looking at, Mark Zuckerberg or Travis Kalanick or whoever. So you're not looking at the failure. So if you look at that, so it's not as high. And yes, like, it is debatable, like the value that some hedge fund managers, they claim that, they're adding lots of value to the portfolio, but many of them don't deliver what they say.
Exactly.
So once through these systems, instead of being a 2 and 20 fee structure, that is now reduced to more like 1.5 and 18. It's still good. It's still really good. If you're managing a couple of $1 billion, it's still really good. But that is still reducing. That is still what's called fee compression, simple supply and demand and competitive pressures. So it is reducing.
Wow. I mean, I think I got about 50% of what you said, but well, this is why we're having this conversation, because I might have some questions myself. So you're saying that hedge fund managers, they will take the basically the clients are endowment funds and pension funds, sovereign funds,
Yeah. I
right?
mean, there are some exceptions, like the smaller hedge funds. Initially, their investors will be high net worth individuals and family offices, but as they
Mm.
get bigger over time, they would rather take 100 million allocation from one institution versus 100, $1 million allocations, because it's just administratively simpler, and they're more sticky. Institutions, they have a more long term horizon, so if you lose
And
money, they're
regulated,
like, oh, I need
I
to
would
exit
say.
as soon as possible. So
Yeah.
over time, as a hedge fund or a private equity investor. So, by the way, whatever I said also applies to private equity people as well.
Mm.
In terms of like the compensation, even they get paid for like very specific needs that they do deliver on. But yeah, over time for the larger ones, the most of the capital will come from institutions because they just control so much more capital.
Yeah. Yeah. Okay. So say there are because for Malaysia we have our pension funds, and I'm pretty sure they've been invested somewhere and somebody's managing it. So how would the government or the one owning the fund um be choosing who to manage? Like, what are they looking for? Like,
Yeah.
how
So
can ensure that you're giving the best
yeah, that's
value?
basically this entire field of manager selection.
Mm.
And I'll usually high level. There's two important aspects. So one is quantitative and one is qualitative. So the quantitative one is simple. You just look at the track record. How has this particular manager performed compared to the asset class that they used,
Mm.
or the benchmark? So if you're a large cap manager or investing in equities, typically it's the S&P 500. If you're a global investor, it's the MSCI EAFE, which is basically all the developed markets. You look at all the global equities.
Mm.
That's what you do. So you just compare them to the benchmark, and then also look at things like, okay, but for the amount of risk that you've taken, what is the return? So it's not purely the headline number of, okay, I generated 25% and the market was only 10%. Like, yes, the reason you generated 25% was you invested everything in Tesla, which is very volatile, and you've taken a really large amount of risk for that
Yeah.
return. You have to always control for the risk that they've taken. This is on the quantitative side. So this is essentially 80% of what you need to look at on the quantitative side. On
Mm.
the qualitative side, it's more like things like, okay, who's your lawyer, who's your auditor? This is like operational due diligence. And then even on the investing side, for the quality side, okay, can you explain your process? Like, how do you screen investments? How do you decide what to invest in, what not to invest in? What is your experience doing this? Okay, if a particular stock is down 20%, how do you decide whether you should buy more or you should exit that position? So you
Mhm.
explain your process in a qualitative manner, and even though it's qualitative, it doesn't mean it should be totally ad hoc. It means that it's a repeatable process. Like, because there are some managers who have even like a checklist, or they put their investment philosophy on their website saying this is like highlight what we do. And then within that, we have our own secret sauce and we have our own edge. And then, yeah, link to edge. Edge means what is unique about your strategy that gives you a competitive advantage over others with the same strategy. And then
Yeah.
source of edge is typically four things. What you can think of as the acronym BAIT, BAIT, which is number one is behavioral, second one is analytical, third is informational, and the fourth is technical. And most investment funds will have some combination of all of these. They'll have like one or two primary ones, or primary, secondary, but typically they have a combination of these.
Mm.
So
Think.
and the institutional process will be really long. So after you have like the basics, like for example, if you're running a equities fund and you're a large endowment, the endowment will say, okay, you have at least 500 million in assets under management. So then we can allocate 50 million to you, because no allocator wants to be less than like 5 or 10% of the LP base for that fund, because there's a concentration risk. Because if there's a very large allocator and someone pulls out, they don't get the fees, they can't pay the employees. It's sort of a downward spiral for them. For this, and then they'll have many meetings. Like you can expect anywhere from like 4 to 20 meetings with the manager and understanding the process and do the due diligence. Because you are stewarding, people like, either like nurses and policemen's pensions. You're entrusting that.
Yeah.
So it's a very intense process on the qualitative and quantitative side to entrust someone's like, pensions to someone else. So it's very regulated for the right reasons.
I'm now curious myself. So for a not for a middle for an individual
Yeah.
with a considerable amount of asset or money, cash to invest in, I don't know, say, I don't know what is a good amount. Where do they go to? I know you're you're
Yeah.
managing, yeah.
So
But
now
for an individual, where do they go?
yeah, so exactly. So the self-serving answer would be yes, give me all your money, I'll invest it. But that is absolutely wrong. I would say it depends on what you consider substantial. So I'll speak about the US context because I
Yeah,
think
yeah.
people listen to
US
American.
context, yeah.
So it makes like hedge funds only make sense once your capital is over like $20 million. And this is excluding your house and excluding, the expenses that you have for the next like maybe next couple of years. So
Mm,
the point of like if you want the answer of like when hedge funds make sense, that is a very
mm,
complicated answer because it sort of depends on how much you're spending, how many descendants you have, how much money you want to leave them, how much you want to give to charity, etc., etc. But if you want a simple answer of okay, I have after you have 6 month worth of savings for your working for your like just basic needs for your needs and your family's needs for the next 6 months, my like personal opinion would be to invest everything in equities in just S&P 500, find the lowest cost ETF, which is
right, ETF. Okay.
VO, which is
Okay.
our S&P 500.
Vanguard, yeah.
Actually, the cheaper one called the SPLG, which is the exact same thing, and that gives you that expense ratio is 0.02%. Well, the Vanguard
Awesome.
are 0.03.
Awesome. Yeah.
And now I'll explain why.
Mhm.
Because like most like conventional financial advice will tell you that you should have basically your age. So if you're 30, put 30% in bonds and the rest in
Mhm.
equities. But I think that's being overly conservative
Yeah.
because you think about it, like most people will have a job and that gives you a salary either on a bi-weekly basis or you're getting at the end of the month. And if
Mhm.
you think about it, that is effectively like a bond stream of income. That's a fixed income stream. So you
Mm.
could get tired and you could get or you could quit your job or your company could collapse, etc., etc. But generally you'd probably find a job in like 3 to 9 months. So let's say you have enough capital to cover that living costs.
Mhm.
What you should be doing is because you should essentially consider your net worth and not just your financial assets. So if you think about it, and the real question is when you're asking where do I invest in, the real question you're asking is how do I maximize my net worth?
Yeah.
So if you want to think about net worth maximization, you have to
Mhm.
actually think of yourself as a conglomerate. And maybe conglomerate is a too fancy term, but basically you have to think of yourself as two different businesses. So the number one is you are the chief investment officer of your financial portfolio. So that's
Mhm.
what people then ask about, okay, where should I invest?
Yeah.
And the second business is actually you are the CEO of your labor capital or your intellectual capital, meaning your job.
Mm.
So you have to make decisions to maximize your net worth. So by thinking about both these two businesses, your financial assets and your career capital. And the way to think about your career capital is it's sort of
Same good
rapidly going to
approach.
keep falling over time. Like let's say you graduate at 21, 22 from college, and then you work until you're 60, 63, whatever, and you basically run out of time. So over time, your net worth keeps dropping, but then you always invest in your savings, so your financial assets keep going up. So
Mm.
it manages such that over time, your net worth keeps going up. So what that means is, in terms of your financial portfolio, just keep it simple. Just put in S&P 500. Just do dollar cost averaging. Do the basics.
Mhm.
But in your career capital, you should be making decisions like a growth investor. So you
Mm.
should choose roles where you think you have a fast chance of promotion. Work in
Mm.
industries which are growing. So work in tech or finance. Build skills over time.
Mm.
Negotiate job offers like stronger because pretty much like if you put all this effort into your financial assets, right, you might get over time something between like 0.25 to like 1% improvement in your investment returns. But then if you
Mm.
put all that same effort, all that brain damage that you have and actually improving your
Yeah.
skill, growing your professional network,
Yeah.
you're
Yeah,
way better off
yeah,
on a
that's true.
like yearly
Mm,
basis, and you have much more control over it, and it is more satisfying. It's like okay,
yeah.
imagine, like I think you had a guest earlier, and I heard him speak. It's like basically, oh, you should build real estate assets. So
Mm,
instead of doing that, instead of having like this really boring job that you hate, and you're putting like 8 to 10 hours each day, and then you're spending a couple of hours each week, doing real estate, which you find fun, or maybe you don't. What if
mm-hmm,
you actually made your life more fulfilling and had a good job, and you were growing and you're using your strengths, and then your financial assets take care of itself because you've done the basics right? So
mm,
I think, like, my perspective is you should be net worth maxing and focusing on your strengths and skills, and let your financial assets like take care of themselves once you've done the initial setup. So
mm.
that is my thing. Even though I should say, oh, you should just give all your money to hedge funds, and I don't think that applies for everyone. They have like very specific needs, and I'm not here to what's called talk my book. So, which means like basically talking about is if a hedge fund manager owns, let's say, lots of Nvidia stock, he's going to say, oh yeah, everyone should buy
Pitch,
Nvidia because it
pitch
works out.
and buy this.
Yeah, yeah. So it's like not
Okay.
I don't think that's good advice. I feel like people should sort of do the basics and focus on their career, which is where
Mm,
most of their net worth is going to come from.
right, right. Thank you. I mean, coming back to what you said about because I think there was a guest that talked about property investing, and so he was going on the route of property, right? You're going on the route of I would say corporate, right? So yeah, and it's really interesting the way he sees it. So like for me, I am going on your route, but right now I wanted to do up my own thing, self-employed. So and I like connecting with people, so I'm moving into a practice of my own therapy and coaching. That's a different story. But to be honest, it is all still connected because somehow financial, we still live in a 3D plane, so we still need to pay rent and eat. So
Yeah, yeah, exactly. So you're investing in
yeah,
your career capital business, right? So I don't necessarily mean just
yeah.
your full-time employment. You could also have side hustles, you build other streams of
Mm,
income, as opposed to just focusing on, financial assets or, real estate investing.
yeah.
There is this idea actually that people in finance understand really well, but people outside finance, or actually even people in finance, sort of don't get this right. So the idea is don't take risks that you're not getting paid for.
Oh
And
yes.
yeah,
Okay.
and what that means is also, like, another way of putting it is, don't take unintended bets.
That's true.
So
That's
so
true.
when people
That's true.
say, like, firstly, people are like, if you have a mortgage and you own a home, already like 80% of your net worth is real estate, and then you're going to do real estate investing using your 401k.
Yeah.
So that's like
Mm-hmm.
insane. Like, in terms of diversification, that's just so like imprudent. Like, it's just insane. I just don't get why people do it. I mean, I get why people do it, but you should not. But I can't stop
Mm,
people. So, like, okay, do what you like. But it is not smart, because the other way of thinking about it is, so okay, you buy a house. Like, what are the risks you're taking? Like, number one, you are actually very long the local labor market when you buy a house, because what
mm,
that means is, if that market is doing well, more people will move there for jobs, and then the price of your home goes up. But then
mm,
what else are you long or short? So then you actually short interest rates. You're short the dollar, because if the dollar goes down, you can refinance and your net worth goes up. Well, if you are, because you're short interest rates and it goes up,
mm.
it moves against you, because
Right.
mortgage rates go up and you pay more on your mortgage. And then
Mm,
similarly, you're actually also long lumber and concrete, because if it becomes more expensive to
yeah.
build another house, the cost of your home also goes up. So now, of course, like, not everyone thinks like this in terms of like financial terms, but basically, when you buy real estate, it's basically all the wealth and all the returns from real estate come from two things. One is leverage, meaning you're just taking on so much debt, right? Because the bank will give you
Yeah.
80 to 85% of the value of that asset. So even if you have like a 2% return, but you're like 4x levered, so your return is like 8% or 10%, depending on how levered you are. So so that's like one part. And the second part is basically tax loophole. So there's something called the 1031 exchange in the US where if you exchange one real estate asset for another, and you do it within like a 60-day period, you don't pay taxes when you dispose of the previous asset.
When you flip it. Oh,
That's what it means. But
right.
what people don't realize is like it can go down. So if you can hit the capital loss or you can just hold. But the thing is with real estate, there's another concept called volatility smoothing or volatility laundering, where it's like
laundering. That's a strong word.
no, but it is true. Like it is strong, but for the right reasons. I'll explain why. So let's say you have a house that's worth $1 million when you bought it in, let's say 2021, and then the housing market goes down. And then when you go and try to sell it, you're only going to get, let's say 700,000. But the thing is, if you don't sell it, you don't lock in that loss. And then you just wait for 5 more years and then sell it at 1.1 million. So did you say, oh, okay, but then the real estate index, it only counts houses that have been sold. So if no one sells it, it doesn't show that the value has gone down. That volatility never goes down. It's always like flat like that and then goes up. So that's basically laundering because you're masking how volatile the risk is. So another way of putting it, like I like putting it, is Schrodinger's risk, like Schrodinger's cat. So if you don't check the box, you don't know whether it's dead or alive. So similarly, if you don't sell it, you're never going to crystallize that loss. So this is another game where people in real estate and private assets play. Where they sort of, if you don't sell it, it's basically called marking to model. Or you can, if you want to, as opposed to marking to market, because if you want Apple or Nvidia or Netflix, you can just look at the stock price. That's the price you're going to get. You know very readily that there's a market price for it. But in real estate or other private assets, it's marked to model where you have this appraiser, or you can just do it yourself and say, oh, the price, the stock market has gone down 30%, but actually this asset is only gone down 5%, and no one would. Sometimes that's called mark to fantasy. Because you can just make up whatever value that you want. So that's why people call it volatility laundering, because you can say, oh, it never goes down. The real comparable for real estate is actually real estate investment trust, because basically what that is
REIT.
Commercial assets, the best real estate, and then you can check the market price for that on a daily basis, and that is way more volatile than equities. So is it more likely that the REITs are real, or your house price, which you marked to fantasy, is real? So if you look at REITs, it's like people say, oh, real estate always goes up. No, but just look at REITs. The price is way more volatile than other types of equities. So the reason it's not as volatile is because you're not telling the true price when it goes down.
Wow. Okay. You just gave an insight there. Okay. So whoever that's listening, they'll be thinking twice now. All right. No, we talked about long selling. My question, what are the benefits of short sellers?
So
there's a
I know there's that armor, but it's not cool sometimes. If you do two, you get this like massive explosion.
Really?
That comes
wow. Oh yeah, I found out just 2 days ago, and I guess it's like he can do like this, and okay. Sorry, yes, you were saying.
So the thing is with short sellers, the way I see them is actually the watchdogs of the stock market. So what I mean by that is the way they get paid is when they contribute new information to the market and they get rewarded for that. That's like the high level. And what that means is the sort of canonical example of that is Enron. So Enron was a fraud. They were like, cooking their books. They had these off-balance sheet special purpose vehicles where they were, just have actually like fake returns. They just like lots of the accounting stuff. And the person who actually conveyed this information that they were cooking their books to this reporter named Bethany McLean at Fortune magazine was a short seller named Jim Chanos. So he figured out, him and his team figured out that, they're like lying about a bunch of things. There's lots of questions because they didn't have any inside information. They're just like looking at the public markets and their public financials. They're like, no way this makes any sense. It's too smooth. The returns are too smooth. The earnings are all juiced. So they present information, and then it's only then when the reporters and Bethany McLean then used this information to ask questions about Enron's business model and their financials, then everyone started asking questions about them. and then the company, like stock price collapsed and the company collapsed. And then now you might say, oh, but then they made this company collapse and, all 15,000 employees lost their jobs and they lost their pensions. But then the counterfactual question is, okay, what if this fraud was allowed to stay on for longer?
Carry on.
More people would have lost their jobs, because what they're doing is they are telling people like, okay, the capital, because you have to think about the stock price as capital that the stock market is giving to this company's managers to continue doing what they're doing. So, for example, Elon Musk, he sort of built this company, and he's been delivering on these promises, like late usually, but typically it does deliver on. So, okay, now we'll sort of buy his stock, and then he can use that stock as capital to compensate employees or to acquire other companies as currency. So, the longer a fraud exists, the more damage it can do over time. So we're sort of better off popping these bubbles when they are smaller. So another example is FTX. So what if FTX was actually allowed to become a massive US exchange, and they actually had plans to, in addition to crypto, also do stocks and derivatives, etc. That would cause damage, like what about 15 billion, I think, the impact. So basically you have to have people questioning different business models. That's one part. These are like the short sellers that actually find and then give more information about frauds in the stock market, and they get rewarded for this. So that's like one part. The second part is less exciting, let's say, because then they realize that, okay, this company has too much capital, like the stock price is way too high based on the economic fundamentals. So we think it should be short. So this basically just prevents companies from getting bigger than they need to be. So you're actually then directing capital from them to companies that are undervalued. So there's one type of trade which is called a pair trade or relative value trade. Now let's say Nike should be $100 billion company and Adidas should be a $50 billion company based on economic fundamentals. But then let's say Nike becomes $110 billion because of whatever reason. Some people are excited, some people are overvaluing their, let's say, new endorsement with this new athlete. So it becomes $110 billion, while Adidas stays $50 billion. So what short sellers will do, or basically most other hedge funds, is that they will short Nike because $10 billion, and then they will buy Adidas. So you want the value to converge over time to the fundamental values. So that's basically a sort of capital allocation piece where you think that, okay, this is overvalued relative to this other company or relative to the market. So then we'll short this other company.
Averaging in some sense, I would say. Are you
maybe, but I think another way of thinking about it is like basically when you think about stock market efficiency, there's two types of efficiency. There's micro efficient and there's macro efficient. And now what it means to be macro efficient is, the S&P should be 5,000. I mean, it's making some numbers up, but based on how the economy is doing and how it will do, it should be 5,000. That is extremely hard to predict because that you're like basically forecasting the entire world, which is really, really hard. I mean, there are some hedge funds which do it and they'll do very specific parts of the economy. But it's actually easier for hedge funds and other investors to focus on the micro efficiency. So this is what I told you. So relative to Nike, Adidas should be 50 billion, or relative to Coke, like if Coke is, let's say, 250 billion, Pepsi should be 225 billion. So the stock market is very micro efficient because there are these people who like specialize in doing this all day. But the macro efficiency, because the interest rates are there, the S&P should be at this level or that level. That is really hard to do. Most like really sophisticated investors will tell you that the stock market is really micro efficient, but it's not macro efficient because it's really hard to forecast where the S&P will be 6 months or even like next month. There are people who try to do it and it's really hard, which is why they get paid the big bucks.
Wow, but they're taking a risk. I mean, their necks are on the line then. I suppose people would be giving their money to them.
Well,
would know
actually,
that
I just remembered another benefit of short sellers is the reason why all these index funds can charge only 3 basis points. Because what they do is they make money from securities lending. So, for example, Vanguard is main ETF, the VO, it's something like 1 trillion. And then they actually lend these stocks to short sellers because if you want to short sell a stock, you have to borrow it from someone. So you could be paying 5%, a 5% rate or a 10% rate or whatever to the people who are long-term holders of this stock. So that's actually how retail investors directly benefit from short sellers because they are borrowing the stock. They are allowing Vanguard and BlackRock and State Street to offer very low low-cost index funds to retail investors. So that's how that's like one really tangible way how retail investors benefit from short sellers. So all like the
Wow.
short sellers, like during GameStop, everyone hated Gabe Plotkin and his hedge fund because they were shorting GameStop. But yeah, but
Mm.
they're paying that fee to these index funds, which allows you to have much cheaper participation in the market.
Mm. Wow. Thank you.
Sure, yeah.
How do you know if an investor is skilled or simply lucky?
Again, it goes to the qualitative and quantitative. So the really basic one is what's called the capital asset pricing model, which is the CAPM model. And that roughly states that, okay, for the amount of risk that you've taken, how much outperformance have you generated? So if you've taken the same amount of risk as the S&P 500 and you've delivered maybe 5%, okay, that means you generated alpha. But if you've taken, twice the amount of risk and only beat the S&P 500 by, 2 or 3%, that just means you've taken more risk. So there's a roughly linear relationship between how much risk you take and how much return you can expect. So that's like the really high level way of looking at it. But then the other things that you want to look at is, okay, what is your batting average? So if you've made 100 investments, what percentage of those have been profitable trades? And then once you've done, and sort of depends on the investing style and the asset class itself. So I'll just stick with stocks for now. So if, like, let's say you're a tech specialist investor, and let's say your batting average is 60%, and then do you think that's good or bad? What do you think? Is that good or bad?
60% batting average.
Yeah, 60% of your investments generate a profit.
Oh, that's good. The heck?
No, that was a trick question. So 60% might seem like a lot, but the real question you have to ask is compared to what? So what percentage
Right.
of tech stocks went up? So for example, the ARK fund, which is very famous for investing in innovation and technology, they can say that, okay, they are 70% of their trades are profitable, but then in their selected universe of tech and biotech stocks, 85%
It's
of
like
the
they're
stocks
living
went
in
up.
their own bubble.
Yeah, so you have to compare it to the benchmark.
Right.
So yes, you have
Right.
to compare the high level returns. So if the
Mhm.
benchmark returned 8% and you deliver 10%, okay, sure, you might have outperformed by 2%, but how much risk have you taken? So that's typically defined as the standard deviation of the volatility. So that's like one way of looking at it, but it's always typically considered incomplete. So you look at, okay, what was your portfolio concentration? Did you invest everything in just Nvidia or just Tesla or 3 or 4 really risky biotech stocks? So was it worth it? Yes, it might have worked out for you, but if you try it again, it might not.
Yeah, it might not.
So that's on
Okay.
the quantitative side. And then again, on the qualitative side, it is, what is the process? Like, walk me through your process. So typically, a manager will walk through 3 or 4 of their investments. So it's basically the same as manager selection, because the whole idea of manager selection is to see that they have alpha, which is, or prescribed as skill. What is your skill? Like, where is your performance coming from? Explain your process. And sometimes you might have a really amazing process. It might sound really brilliant and intelligent, but then, okay, let's see your 1 year, 3 year, 5 year, 10 year track record and see if actually your process is working out rather than just sounding really smart. So that's how we look at it, qualitatively and quantitatively.
Thank you. Okay, moving on to yourself. What are your 2 main tactics in negotiating your job offer?
So now I'm sort of like doing my own thing. So, but from when I
Okay.
was, just working for the companies, the 2 main things that you need to focus on is, number one, you have to get the hiring manager to like you. So not HR or not some other colleagues that you work with. It's like the person who has the decision-making authority to hire you or not. You have to convince that person that you are the best person for the job. You have done this before. You can start adding value immediately, and your learning curve there's no learning curve. Like, you've already done this before. You should make it as simple. Like, look, I've done X, Y, and Z before, and I can do X, Y, and Z for your company starting 2 weeks when I start the job. You should, and they should also firstly, they should believe you're competent and they should like you. So for this trick, you should use whatever is to your advantage. Like, because we like people. We trust people who we like, right? So you should use, you probably heard of behavioral bias, cognitive biases. You should use, the affinity bias. So people who are similar to us, And this similarity can be extremely superficial and it still works. Like, oh, we both have iPhones, or we both have the same
We
initials.
both play soccer before.
Yeah, exactly. It can
Football.
be extremely superficial and it can be something more substantial. Like another common one is, oh, we went to the same university. So, which is why alumni hire other alumni. So, if you go to a top university and their alumni work at top firms, that's a good way of like ensuring your success, ensuring the maximization of your career capital as well. So that's the real benefit of going to a high price college. And it's not what they
Right.
teach you, or the diploma.
It's the
So creating
networking.
his affinity and the network. Yeah.
Yeah.
So get them to like you and get them to trust that you're competent in their job. That's the first part. The second part is just get multiple offers. So then you sort of create an auction for yourself. And then there's also like a hierarchy of offers. So let's say, for example, you're working at DoorDash. You want to get a job offer at DoorDash. You have to like the best offer that you can get is, hey, I also have offers from Uber Eats and I have offers from
But
Uber.
it has to be real, right? You
Yeah,
can't
of course,
you can't fake it.
Yes, yeah. It has to be real because the thing is, typically
Or
it's
you can
always
fake it, but well, fingers crossed that you're gonna you can use that to your advantage.
I mean, you could, but I would say it's better to just be ethical and
don't.
just
Yes,
actually
yes.
have a job offer. So it's better to have
Exactly.
job offers from direct competitors, and then the next best would be to get from indirect competitors. So, if it's like Uber and DoorDash that you're trying to get job offers from, the next best would be other tech companies like Google or Netflix, which are a similar stage, so like large other public companies. And then the next best would be in the same industry but different stage. So if you get a job offer at Stripe or any other large public tech companies, and then the third one would be you just have any job offer, like, oh, I have this offer from McKinsey or Accenture or Deloitte or whatever. And then the fourth one is actually, if you don't have a job offer, you can actually sort of just make up a job offer. And what that means is, oh, actually, I'm also considering doing a master's, or I'm going to do a travel abroad.
Right. Anything that
Yeah, it just has to be
appreciates
that you have options in
your
life. You're just like not going to
yourself.
be sitting on your couch at home.
Yeah, yeah.
And the one is like, basically, yeah, I'm
That's a
considering
good
that.
one. That's a good one. Yeah.
And you can make it up, like in the sense that you can create it for yourself. So you just basically say like, oh, I'm just going to be here in 3 months. If you don't find anyone else, you can hire me. You want to avoid that situation. So it's basically get a job offer from a direct competitor, then indirect competitor, then some other job offer, or then something else. So you're going traveling or you're going to do volunteering work or whatever else. So these two tricks, get the manager to like. And one is get multiple offers, and this covers like 95% of whatever you need in a job offer negotiation.
Wow. Did you create that yourself to your experience, or did you actually learn it from somebody else?
Yeah, like mix and matching from like like personal experience as well as reading in negotiation books and listening to other people's experiences, or mostly what they did wrong. Like typically you very rarely hear about how some negotiation went really well and how they were very strategic about it. It's typically always I screwed it up. Like
I screwed it up. I should have done this.
$20,000 more, but I made this stupid error saying yes. When do I start? It's always when something went wrong. So it's like, yeah, just avoiding doing like the wrong things, and that sort of you end up in a good place.
Wow. All right. I'm mindful of the time for you, Drayton. Just a few more questions. So what is next for you?
So for me, I'm just focused on Towers Capital and delivering what I promised for my own investors. That's the main goal for me professionally.
Okay. So, I'm going to pivot to self-worth question. Can you share any personal experiences or stories of self-discovery and how it positively impacted your sense of self-worth?
I think maybe this is slightly unconventional, but I sort of always had a decent amount of like self-esteem and self-worth. And in fact, as I told you, like I was always a bit understimulated. I always thought I was maybe not underperforming, maybe like not like underemployed at work. But even as a student, I thought I was like just massively understimulated. I could do more. So I was always seeking out more challenging, like, hobbies and trying to do more interesting things. So I've always felt I could do more, but I had this like nagging feeling, but I didn't really have any proof that, oh, actually I can do better, I can do more.
Yeah.
And this sort of changed when I did my master's. So I went to London Business School, and you had students from elite universities across the world, from China, Australia, US, UK, like Oxford, Cambridge, everywhere. And I saw that my grades were comparable to them. I was participating in class, and the grades that I had was quite comparable. And then soon right after that, I started working at Goldman Sachs. Within like 2 or 3 months, I was speaking to people who were like actual billionaires, like managing billionaire portfolios at some really sophisticated hedge funds and sovereign wealth funds and endowments. They valued my opinion, so I could see that even with my other colleagues, that they valued my opinion and what I had to contribute. So I was like, maybe I am good and I can deliver value even despite not going to like a world-class university. So for my undergraduate degree, so that sort of gave me a lot of self-belief, and I didn't have a chip on my shoulder, but if I did, that sort of quickly dissolved away because I sort of became, it was in these elite circles and I could go toe to toe with them. So that was a good sort of realization, and that helped me a lot.
Essentially, just believe in yourself and just go out there.
No, but that's the thing. I sort of believed in myself from the beginning, but I didn't have any reason to believe myself because like I'm not achieved anything. Like what have you done? Like why do you have so much self-confidence about when I was in like a very tough, high pressure intellectual environment, and then I delivered my I had top quartile performance reviews in all my performance reviews. So I was like, yeah, okay, maybe I do know something, and my self-belief is justified because if you have self-belief and you don't have confidence, you're just like arrogant and delusional. But I was then able to justify my self-belief because I was able to compete and add value in a professional setting.
Wow, thank you. So yes, Drayton, what is your heart's greatest wish?
I sort of thought about this question, and I think the best answer I could come up is I want my friends and family to be happy and healthy physically, mentally, spiritually, emotionally, and the same for myself. So nothing very exciting. It's just really simple. I just want my friends and family and myself to be happy and healthy, I think, and content. I think that's like, that's what I can think of. Yeah.
Thank you. I think that's a very honest answer. Thank you very much. So do you have a mantra that you live by?
Yeah, a few, and I try to live by it, and I sort of need periodic reminders because I always forget, day-to-day grind, etc. So I think one is you can't be normal and expect abnormal results. That's one. Or another way of putting it is extraordinary people get extraordinary outcomes. So if you want something to be superlative, you can't do average things.
Yeah.
So that's
awesome.
One thing I live by. So if I sort of see myself doing like, oh, how do I do this? Like, yes, until you reach a baseline level of competence, you should just, copy others and look for best practices online or from your colleagues or whoever else. But then after you reach that, if you want to go take it to the next level, you have to do extraordinary things, or you have to be different. So that's something that even I need periodic reminders. And then another one is believe in yourself and then act like it. So everyone says, yeah, have self-belief, blah, blah, blah. But yes, you should act on that self-belief. So a question to ask yourself is, okay, if I had, 10 on 10 self-belief, or someone in my position who was extremely confident, what would they do if you want to externalize it or, have an outside view of what to do in that situation? Because you're sometimes just too close to the situation because you can't read the cover of the bottle if you're in the bottle, right? So think about, okay, like, what would someone else who had amazing self-belief do? But basically the mantra is believe in yourself and then act like it.
Wow. Thank you for that. So is there anything that keeps you up at night, or do you sleep well?
I sleep quite well. What keeps me up is like I like to sleep when it's cold. Like I like it like 16 or 17 degrees Celsius.
Oh my God.
So I like it really cold while sleeping. So that like any sort of heat keeps me up. But if you're asking what I do stress about, not really, to be honest. Like it's mostly just, because my sort of mantra is in terms of like risk management, in terms of both like, the financial assets as well as careers, don't do anything unethical, or it's even, don't go close to the edges legally or ethically speaking. Insure all catastrophic risks. So like I have home insurance risk, auto risk, life insurance, etc. And that's sort of, then everything else I can handle. It's not a big deal. Like you have this self-belief and you're sort of optimistic that whatever life throws at you, you can handle it. So it's fine. Like, yes, there are lots of things that suck in my daily life, but it's fine. I can deal with it. So it doesn't stop me from sleeping well.
Thank you. Right. The last question. If you could create a quote right now for you to leave to the audience listening and the world as your legacy, what would it be?
It would be, you are always one decision from changing the rest of your life.
Wow. Thank you so much, Drayton. I think you've certainly shared a really, really great insights onto the investment world. And I think my audience and whoever is going to be listening to this podcast would greatly benefit from that. And the part on your real estate, I never really thought it that way. And I think it would make them think twice about what to do. And I think still the key is to try and minimize as an individual, myself, just minimize your the expenses and then try to maximize in a way that you're talking on your financial assets return as well as your self investment, because I always believe investment in self is something that you can never take away.
Yeah. I would just sort of slightly caveat that by saying minimize your fund expenses.
Yes, sorry,
And
minimize fund expenses.
yeah, because this was a mistake that I made. I was overly miserly early on in my career. I was like, I need to save everything, and the FIRE movement is quite popular as well. You sort of end up having a miserable life for 20 years, so then you can retire and then have a miserable rest of your life by just minimizing expenses. But it's like,
Yeah,
sort of enjoy your life a little bit.
that's right.
Because that's the point of making money. What's the point of making
Exactly, the balance, right?
shitty part of your life? Exactly. Yeah.
All right. Well, thank you so much, Drayton, for your time. I appreciate it. It's 10 o'clock at your end, and it's 10 a.m. my side. Once this airs, I will be sure to tag you on the LinkedIn. So if there's anybody here who would like to reach out to you, how can they do that?
Yeah, you can reach me on LinkedIn or follow me on Twitter. Just look up my name, Drayton D'Silva, DRAMITON, D''SILVA, D'Silva, Drayton D'Silva. Yeah, I sometimes post about, some investment concepts and financial concepts, especially if it's slightly tricky, like, the real estate one. I'll have something on volatility laundering soonish, other similar concepts. So I like, I like financial education because everyone who's like really into like talking about financial education, they always, yes, I'm in real estate and then buy my real estate course. So it's like they're not telling you what you really should do. It's like okay, if you're making so much money in real estate, why don't you just continue doing real estate? Why are you selling this course? So it's like it's like I told you.
Oh,
It's like
yes, that's actually true.
yeah, it's like if I'm so good at investing, I should charge you 220 fee, and I should not sell you, hey, buy my newsletter for $50 a month. So like, hang on, like something doesn't compute. If you can make millions of dollars
Something is
investing, why are you
off.
selling this course or whatever? So that's I don't know, something that's sort of a bit problematic in the general financial education space. Meaning there's not that many independent or at least impartial advisors and educators. So that's something that I don't have a solution to it, but it's just good to know that people have the sort of bias there. So and I hope I have been balanced in the conversations. People should just be more aware about it because it is really important. Like people know, like health is important, but your financial health and well-being is also extremely important. Like for the lifestyle that you have for yourself, for your family, and maybe even in Asia generally, people get to support their parents as well. It is extremely important, so people should take it more seriously.
Exactly. And to be honest, a lot of people just want to close their eyes, and I have colleagues coming to me and say, Nick, what should I do? I'm scared to look at my finances. I'm like, dude, you have to. But
yeah, it is important.
You have to, and then just give their money to somebody.
But it's a bit like the same thing, right? Like, people hesitate to put themselves on a weighing scale. It's like, oh no, I don't want to see.
I know, I don't want to deal. I don't want. Please, let me just, let me just eat this ice cream and then figure out what do I do next about my weight.
A former boss of mine had this really good saying. He said, I don't look in the mirror, I don't step on the weighing scale, and I don't look at my bank account. Like I just named the works.
No, I had one family friend as well before said I never go to the hospital and get a checkup. No, I feel good. Oh, but God bless his soul. He did have some complication, but his passed. But and my dad took that and is like, no, I have to go to the hospital and get a checkup. At least you don't worry, but you have that safety net in the sense that where the needles are pointing in terms of your health, and that goes with your
absolutely,
financials as well. All
mean,
right.
yeah,
Well, yeah.
it's like
Oh,
like
yes,
two things,
yes,
right?
yes. You're saying, yeah.
No, I was just gonna say it's like there's two things. It's either ignorance is bliss or knowledge is
Yeah.
power. Like which one do you want?
Yeah. Yes, that should be your another mantra. Ignorance is bliss, knowledge is power. I stand by that. Two mantras,
Yeah, yeah.
very
I
much.
really enjoyed our chat and I enjoyed listening to
Yes.
your podcast and you've done a great job so far and wish you all the best as well.
Likewise. Same to you, Drayton. Thank you so much for your time. Bye bye.
Thank
You
you.
take
Have
care.
a good day. Yeah,
Have
bye.
a good day. Have a good evening.
Thank you.